To remain updated with the latest business news, click on the bell icon.
You're watching Ask Udayan, the show where we answer your questions on stocks. I'm Amara Bakaya, with me, our global business editor, Udayan Mukherjee. The Indian stock market is trading close to record highs. Investors sometimes unsure whether they should stay invested or book some profit. So what are some of the best investment strategies you could apply in a market that is booming at a time like this? Udayan, of course, with us to give you some of those answers and to also look at specific stock queries every Wednesday. Do continue to send in your questions at the number on your screen, and we will, of course, take some of those. Let's start off with the ones that we've picked today. Our first question is from G. Chadha in Gurugram. Let's listen into his query.
Udayan, what will be the market forecast for investment in Happiest Minds for 1 year investment period?
Well, as you know, Happiest Minds has been an absolute cracker. I mean, I think it's a three-bagger over the last 1 year, and I can understand the interest in that counter because people have made so much money over the last 1 year in that name. I think it's gone up a lot already, and therefore one needs to be a little careful about the price. As a company, it's a very good company. I mean, that's why the stock is doing so well. And it's got an excellent promoter. The management is very good. The unique thing about Happiest Minds is unlike a vanilla IT services player, like say the likes of Infosys and TCS, this one is focused more on the digital segment of the entire IT piece. And since there is an explosion which is going on in the digital universe, obviously people are willing to pay a much higher price for a company like Happiest Minds, which is targeted at that digital segment. Now, you know, the problem with Happiest Minds, and the only one, is that while it's a very fast growing company, and in the next 2 or 3 years it will probably continue to compound at 25% plus, which is a very healthy growth rate. The issue is of valuations, because the stock is already trading at about, I think, a P multiple of something like 80 times. I mean, that's very, very lofty for an IT company. But so you need to be a little careful about the entry point. The stock has already corrected. Of course, it was almost at 1600, has come back to about 1300. So if you get it in corrections and as close to the 1000 rupee mark as possible, I think it's probably a good one for the long term. I would also request you to tweak your holding period to more than 1 year. I think for a stock like Happiest Minds, it's best to hold for maybe 3-4 years and let this whole digital drive play out. It may be more rewarding for the longer term, but just be mindful of the price and the valuation.
Here's another interesting question from Praveen Prakash in Bengaluru. Let's listen in.
Hi, I have purchased Amara batteries at an average price of 882. I'm looking for a long-term investment of a span of 3 to 5 years. Should I hold or exit?
Well, Amara is not a bad company. I mean, if you are looking at the auto batteries and auto component space, I think it's probably the best bet. I would say that if you look at the comparative performance between the two big companies there in the listed universe, which is Amara and Exide, Amara is probably a better performer compared to Exide over the last 3-4 years. It's steadily gaining market share. It operates on better margins. The return profile, return on equity, is also slightly higher than Exide. So I would say between the two, Amara is probably the better stock to own. But you bought at 880 and the stock is already at, I don't know, close to 700 level. So you're sitting on losses out there. And the market is not seeming very confident and gung-ho about prospects for Amara. And part of the reason, of course, is to do with what's going on with expectations on electric vehicles. Because the traditional auto and the traditional auto battery segment is something which investors are a bit skeptical about. So Amara will have to prove its mettle on the lithium ion batteries front to demonstrate that it's going to be a credible player in the electric vehicles arena as well. So I think that's one challenge. The other is that copper prices have been going up, lead prices have been going up, and because of raw material price inflation, their margins are also getting squeezed a bit. So on both these counts, the EVs factor and the operating margin squeeze, I think it's very difficult to see how Amara will be a great performer over the medium term. So while it's a good company, I would say maybe it's a better idea to look at other companies as well, even outside the auto space, for the kind of time horizon that you spoke about.
Okay. Ajinder Kaur has also sent in her query, and we've got a lot of queries coming in from the broader markets today. Listen into this one.
Hi Udayan, my question is what is your view on APL Apollo tubes? Should I buy at current levels? Thank you.
Well, APL Apollo is a very good company, and if indeed there is going to be a rebound in the investment cycle and the capex cycle, as most market participants seem to believe, I think APL Apollo is positioned quite well to ride that wave. It's been a very good performer as well over a period of time, and in fact in the last 2 or 3 years it's been one of the best mid-cap stocks. Again, the issue is about valuations. Your question is about an entry into that stock. It's already trading at about close to 28-29 P multiple on FY23 earnings, so it's not exactly cheap. Compounded with the fact that steel prices have been going up, so they might face some kind of challenge on their margins in the foreseeable future because steel prices may not cool down immediately. Of course, if they manage to sell more value-added products, which is the hope, then they could pass down some of the steel price hike and preserve and protect their margins. So it may turn out okay for APL Apollo, but I think the key thing to understand is that it's a good company in a good space. It's an absolute leader in the pipe segment, and therefore, if you don't mind going without great returns for small periods of time, 2-3 quarters on the trot, I think it's probably an interesting name to have in one's portfolio for a longer time. I'm not going to be a judge of what is the perfect entry point because of where valuations are now. But having said that, the stock is trading at 15-17% lower than its peak that it hit a few months ago. So it has corrected somewhat from the top, and therefore you would not be buying it at all-time highs. So this is not a recommendation for buying that stock at all. But I think it's probably a very, very good portfolio stock for a mid-cap investor.
Samarth Parekh also has sent in his query, and this one's from Kolkata, particularly on the tech space, given all the action that's been brewing there. Listen in.
Hi Udayan, welcoming the Amitabh Bachchan of the last year back. It's very nice to see you again. I just wanted to ask you whether Mindtree can become the next Infosys or TCS. It's been outperforming the IT pack, but what is the future?
Well, as you said correctly, that Mindtree has already been outperforming the frontline IT stocks quite handsomely. In fact, I think I wouldn't be mistaken in pointing out that it's probably the best performing stock of any size in the IT space over the last year or two. I mean, it's been an absolutely stellar performer. And part of it, I mean, of course, it's well deserved because it's growing at a much faster clip than most of the IT names that you mentioned. I think Mindtree has been growing at 35% on the revenue front in dollar terms, and that is absolutely astronomical. But because of this reason, it also trades at near all-time highs, and it's trading at a premium to even TCS, which is the big daddy of the IT space. I think TCS trades at about 32 times. Mindtree is probably trading at 35 PE multiple. So, you know, a 10% premium to probably the bluest chip in the IT space takes some doing. I think you cannot fault Mindtree on the kind of execution that it's doing. Even the quarter gone by, I think the revenues went up 13% quarter on quarter. I mean, that's really a hard act to follow. So it's a good company, good management, excellent growth track record, and nothing to suggest that their growth is about to slow down immediately. If you own the stock, good luck to you. By all means, it makes sense to keep it in the portfolio. And maybe use corrections. Periodically, you do get corrections in the market, and that's when you should try to look into adding to your portfolio on stocks like Mindtree, which, as you said, is the best in class on performance in the IT space over the last 4 or 8 quarters.
If you like the video, do like, comment, share and subscribe.